When did you think this up? This morning or yesterday?
So my name is Steve Shay, and I try not to follow Mike Devereaux in any speaking engagement. And you'll see we clearly did not coordinate at all, zero. So I'm going to skip a whole bunch of slides. And I did not get the message, Mike, not to follow the title, because I'm trying to do options for U.S. tax reform. The easy part of that task is there are almost no options left. So you'll see the third bullet is the GOP, which is watching its primary option from the House crash and burn, although it hasn't been fully recognized yet. There is no backup option. So here's the order of discussion. I'm going to talk about the political economy of tax reform. We'll compare that with Michael's analysis of the DBFT in a moment. I already did my 94-page paper on the blueprint, which is trying to follow Michael's approach closer. Today I'm just doing politics. Then I'll go through the tax reform campaign proposals. And the reason I say that is the blueprint that we're all agonizing over and focusing on, as Mike said, was issued in June of 2016. It was issued by Speaker Ryan as something that the House GOP and the GOP generally could run on in the 2016 campaign. And part of what's unfair about the way we're approaching that document, we're approaching it almost as though it is legislation. It is the farthest thing from legislation that you can have, and that's creating a huge problem, as we'll see in a few minutes. Trump also had plans during the campaign, when you compare, which I'm not going to go through all those slides, but if you go back and looked at my slides with the slides I have that slightly elaborate on Michael's slides as to what the most recent plan is, they basically put out their campaign document in even shorter form with no numbers and even less specification after they became the administration. It's one of the first times I've ever seen a campaign become, an administration become less specific than a campaign. I got called early in the process in the last campaign by people, really good, well-meaning tax people, to share ideas about what should, in this case it was the Democrats, think. And I said, look, the basic rule of thumb in any presidential campaign is the less you can get away saying about tax, the better off you are. And this is because nothing ever good from a tax policy point of view comes out of a U.S. political campaign that I've seen so far. A little bit this responds to the earlier comment. Obviously, politics is a very important part of our tax system. We want to take into account people's preferences. The U.S. system just doesn't seem to do a very good job, and what comes out is just mush. So I'm a little bit on Richard's side of let's try and have people translate what the people's desires are into something that, whatever that desire is at least a reasonable tax system. There has been no plan issued since the campaign that is more advanced than before the campaign. So we have no tax plan. And so I'll just take a little bit on what are some of the options. And they're really, right now there are no coherent options out there. I can sketch where I think an end game might be. But if I had to bet right now, the end game is we will not have tax reform before 2018. And we can see why. Okay, so this first is governing versus campaigning. And the second line, if you're going to govern, you have to know your numbers. How much revenue does your proposal pick up? So the Trump plan in the campaign would lose $5 trillion. That's not a serious document. The House GOP blueprint, admittedly, as it's been looked at by the Tax Policy Center, would lose $3 trillion. Now that admittedly includes some very worst case revenue assumptions And that includes giving transition to everybody. In other words, they interpreted the blueprint as though all the debt before the effective date would continue to get an interest deduction, and the interest deduction disallowance in the plan would only start for debt issued after the effective date. All investment pre-effective date would continue to get their depreciation, and only new investment would get expensing, as opposed to new investment getting expensing, screw old investment and don't allow depreciation. So, but with some fairly reasonable assumptions, that's a $3 trillion revenue loss. That's not a serious governing plan. Second, winners and losers. Economists and those of us in this room like to think hard about efficiency, want to have efficient tax systems. When you're a policymaker, and if you want to get anything through a Congress, and a divided Congress, which even with total Republican control is very divided, who are your winners, who are your losers? The simple reason the destination-based cash flow tax starts out with a horrible disadvantage is the biggest company in Arkansas is Walmart. It's a big importer. There are 2 Republican senators. The Republicans have 52 senators. They cannot lose more than 2 without relying on Democrats to pass a bill. So already, if you haven't persuaded Walmart that this is a great thing, and I can tell you they have not been persuaded, you're behind the 8 ball. So second element of governing is winners and losers. And the third is fairness. And it's interesting, as you'll see, I don't think the GOP thinks, GOP is our Republican Party, sorry for the acronym, Grand Old Party is what it stands for. The GOP doesn't think about fairness the way a lot of people think about fairness. Their idea of fairness is individualism and hard work will result in outcomes that are fair because people will get their just desserts. That's proving to be a problem for them today in terms of their health care plan. The House blueprint, again, a campaign document, 1 sentence on fairness. That 1 sentence said, no income group will pay more tax. No income group. So if we do is we divide income groups into quintiles, 20% brackets. And none of them, under their analysis, would pay more tax. We'll see in a moment what it still ends up doing when you think about it in relative terms. It's very, very regressive. So revenue. When you think about, I'm just going to go through these 3 things quickly. When you think about revenue, you have to decide whether you're neutral, you're going to lose revenue, or increase revenue. GOP will not increase revenue. It violates an ideological standard. They don't want to lose too much revenue, so one of the end games coming out of U.S. tax reform is, okay, let's just lower the rate, lose some revenue, and not worry about it. The trouble is that the party has a significant subgroup of deficit hawks that you can't lose too much before you lose more than your 2 votes. Just think in terms of 2 votes. When you're campaigning, the GOP doesn't really have to worry about this. As you could tell from the 2 plans I just described, that proves the point. I don't have to say more. But part of it is the composition of the base of the GOP party. They're sort of oriented towards small government. And frankly, in campaigns, people don't pay attention to numbers. Whereas in governing, the numbers are really important. And we've seen 2 and now 3 very significant tactical, maybe strategic errors on their health care because they put things out before they knew where the numbers were. Then the Congressional Budget Office comes out with what we call a score in the business, and all of a sudden their coalition falls apart because people start to see who the real winners and losers are from the numbers, as well as, and we can come back to that a little bit. Winners and losers, I think that's self-evident. But there is, interesting, the economists have something to tell us. It's called loss aversion. Just going to some of the behavioral economics. But in politics, losers tend to be more active. A small group of losers are more active than a very broad group of winners. And if you haven't thought that through before you put your plan out, and you get the wrong losers, witness my Walmart example, then you've already shot yourself in the foot. And then fairness, we've already talked about that. The net of all this is this is why I say the less you say in a campaign, the better. If you can get away without being very specific. Because before you put out a plan that you're going to try and pass, you need to understand all three things, and you need to have answers for all three things. And the current experience in that both the House is none of those questions have been answered. So they've gotten very far out front on a set of plans about which they know practically nothing that's important if you're going to pass it. That's not good governing. We basically have as Mrs. Pelosi said quite a while ago, when the House bill first didn't get through the House, there are a bunch of rookies at this point in this business. And frankly, everybody learns on the job, but boy, the learning curve, particularly for the White House, is extraordinary because there's very few people in there who've actually had government experience, and it's a serious cost for these reasons. So I do have in the slides a comparison of the plans, and in very general terms, one thing, I'm going to just take a moment. You cannot understand the U.S. tax system without understanding that we do not have a federal level value-added tax. We don't have something that we can slip a 4.5% business surcharge into, and it will make up for reducing the tax on income. We have an income tax. The business share, the corporate tax share of total federal receipts is over a number of years, roughly 10%. Of the individual, the rest, then we have about 9% of excises and other things. And very close to 80% of our revenue comes from the individual income tax and the payroll tax. Of that individual income tax, the United States, unlike other countries except Germany, includes a substantial amount of business income that's earned through what we call pass-throughs, partnerships. On my very rough numbers, working off of something Tax Policy Center did, it looks to me as though that accounts for somewhere like a little more than the corporate income tax in terms of total taxes as a share of the total federal pie. So the business tax then goes up into the individual income tax in both systems, both pass-through and corporate. So the individual rates are important, and they're dropping those dramatically, in addition to trying to drop the tax on business income dramatically. That's just a huge amount of revenue that you have to make up somewhere, and that's the source of the problem. I'm going to stay out of some US-specific stuff. This 3.8% tax on the bottom, it was going to be repealed as part of health care, but it's worth pausing on that. So when the CBO report came out on the Senate health care bill the other day, in broad terms, $1 trillion less spending, less expenditure on health care. So you'd say, oh, that's great for our budget. But then they gave away $770+ billion in tax relief, overwhelmingly. The biggest part of it was this, well, a big part of it was this NIIT, to taxpayers whose incomes were high incomes. The NIIT only applies if you're earning $250,000 or more. You have more than $250,000 of taxable income for a married filing jointly return. So that showed complete blindness to fairness issues because that reduction in expenditure will fall overwhelmingly on the not so wealthy, and the tax relief goes entirely to the wealthy. And now that's part of why the health care package on the Senate side is unraveling, and they haven't been able to solve it. So for campaigning in the Republican Party, you could ignore fairness. When you get out and you have to pass something, and you have to include in your coalition even Republican senators who come from states that are adversely affected dramatically on a fairness grounds, it's not so simple. And that's the difference between campaigning and governing. I'm going to skip all the specifics and just go to a little bit about the House plan. Lower taxes on individuals, lower taxes on capital income, good reductions, or substantial reductions from where they are now. I say good, that depends on your point of view. It's not a point of view I particularly share. The corporate tax rate under the House plan, and similarly the Trump rate of 15%, is fantasy. in light of the numbers. So and here's part of the political calculus. A few years ago, the Joint Committee on Taxation provided numbers that said, how low a corporate rate could you have if you eliminate every corporate tax expenditure? And it gets down to about 28%. You'll notice there's a delta between that and 20. And if you say, okay, well, I still want to go further, then if you think about the implications of that, you have to then increase tax, broaden the base, eliminate expenditures that affect individuals. So here, in the US, not here, it's very hard to have a political plan which says we're going to increase taxes on individuals in some way that becomes obvious in order to reduce corporate tax rates. Now, the problem is even more difficult because even those corporate expenditures that would expand the base, repealing those also affects individuals and pass-throughs. That's part of the difficulty of this roughly 50-50 mix we have between the corporate sector business and business being conducted domestically through a pass-through sector. If we just go on rates, the distributional effect of the rate reductions is very, very powerful. The TPC estimate that 3/4 of the overall tax cuts in the overall blueprint, which does include individual as well as business, would benefit the top 1% of the income distribution. And they estimated that the top 0.1% would save $1.3 million annually. So as you can see, you can not raise tax on any quintile, but nonetheless, almost all the benefit goes to the top quintile, and actually most of it goes to the very, very top. And that won't be lost at the end of the process, although if this plan had any legs, which it won't for reasons we'll get to. Mike's talked about expensing. Expensing has many positive attributes, but with the way it's done in the blueprint has a lot of noise. And then we have this very odd, if you're trying to create a destination-based cash flow tax, you usually do it along lines, you either disallow interest and then not include financial income. This plan disallows interest, includes financial income. That actually goes back to a Bush tax reform advisory plan, and it was based on a political notion that you can't say to Americans that people are not going to pay tax on interest. I mean, it's really just, it's a politically driven aspect. The House GOP plan has no specification of transition. So we don't, notwithstanding what I said earlier about the revenue estimate for Tax Policy Center, we don't know what they would do in transition, which is an indication we have no plan today as a practical matter at this stage into the new administration. I'm going to skip over destination basis. I think Mike's already talked about it, except that is the feature that has made the House plan viewed as dead on arrival in the Senate. So let's just, where are we? We don't have, if the destination feature is pulled out, they lose $1 trillion of revenue. There's been very strong opposition already to the interest disallowance. That's roughly another $1 trillion of revenue. So you're down $2 trillion. And that's part of why, at this stage, what is Plan B? This is my fuller picture. I like Mike's slides much better, but this is what I think the Trump administration, where they end up in their one page. I have two slides, but it basically was on one page. And this second page mirrors what Mike said. Go down 50%, move to territorial, one-time tax on existing overseas profits, and eliminate tax breaks for special interests. What are the other possibilities? The Senate has spent a lot of time talking about integrating the corporate and shareholder taxation. And just here are some factual background. The percentage of shareholders of U.S. publicly traded companies that pay tax on dividends is roughly 25% of the total shareholders. roughly 50% are exempts, pension funds, endowments, and roughly 25% are foreigners. A very crude, rough. Some people think the taxable share could be as high as 50, but I think the most recent really scrubbing of the data suggests it's closer to 25. So you can't get rid of the corporate tax, make it up at the individual level, unless, as any proposal that comes out in this direction will do, you impose a withholding tax. That means you're imposing a new withholding tax on tax exempts. And I'm not sure that that's going to be viewed favorably by the tax exempts and pension funds, even though economically it ends up being the same whether you get it at the corporate level or through a withholding tax. But I think politically it's a very, very heavy lift. I'm going to skip to the last one. Add a VAT to fund reductions. Professor Gratz, Harry Gutman, a number of others have made that proposal, widely understood to be dead on arrival politically because we have a very significant part of the Republican Party that will oppose any new tax. They view the value-added tax as a new tax, and we're still a couple of years away from a rational discussion of a value-added tax at the federal level. So that only leaves the middle bullet. There was a proposal fully worked out that got down to a 25% rate in the end of 2014 on corporate income, and it was dead on arrival, even though it was put together by then House Republican Ways and Means Chair David Camp after tons of work and input. And that's because it had not been screened for winners and losers, and the losers just said, you can't even put that out. So I was in Treasury throughout the last major tax reform from 1982 to 1987. And the process went like this. We spent all of 1984 drafting a plan that nobody saw. We made it public, got lots of comments and lots of criticisms. Jim Baker, one of the best political minds of the last half century in the United States, moved from the White House to the Treasury, went through every part of that plan, and figured out who the winners and losers were, and only then did it get sent to the Hill. And that's what isn't happening at all now. That's what's needed. And even then, that plan died 3 times on the way to completion. But without that form of a process, really, the Republicans seem to think you can do health care and you can do massive tax reform with a click of the mouse. And that's just not the way it's done. So, and as of now, there's no plan B. And so that's why I come up with thinking we're not going to have to worry about tax reform through 2018. Thank you.